Hi everyone, it's Jack back with another video, and today I'm going to be talking about my UK dividend portfolio March 2023 update. So these are going to be the changes that happen in February and March. First of all, 25% of this portfolio is VUSA, which is an S&P 500 ETF, which obviously doesn't pay the best dividend yield, nor is it really a UK dividend stock of any kind. I'm quite happy with this. I think having an S&P 500 ETF is a big insulation from risk of the UK economy failing, for example, which it's not likely to do, but it's a necessary bit of diversification in my opinion. It also pays a 1.3% dividend yield, which I'm quite happy with. And overall, I think S&P 500 is a nice cornerstone to have in pretty much any portfolio. It's around 25% of the portfolio. It came down slightly last month, primarily due to the strength of the other stocks because the FTSE 100 increasing in value significantly and the addition of a new position. Then, the larger position of an individual stock is DIAGEO, which occupies about 15.8% of the portfolio. This had actually came down as well. Stock struggled recently despite pretty decent results in my opinion, positive revenue, positive earnings increase. It does have a relatively high PE versus the FTSE 100, but below historical averages. I'm very happy with my current position size. Not really willing to add over say 3,200 or something like that, but built the majority of this position around 2,500 in 2020. So I'm pretty happy with this position sizing. Don't want it to go in the realm of 20%. 15% is about right for this, and I actually like it to come down over time while maintaining this position size from increasing the rest of the portfolio. Second largest individual position in this portfolio is Redrow at 13.1%, the small cap house builder, around 1.5 billion market cap. That PE there is essentially meaningless at 4.9, that's on a trailing basis. They've announced that their earnings are going to take a big hit, but crucially they are maintaining the dividend going forward. Stock is essentially flat year to date, 5-year return of minus 21%. I'm very happy with this position. I might actually buy more because I haven't really bought any more since around March 2020 or April 2020. I'm seeing a nice re-entry point here. Profit's going to be down for at least a year, but the stock price hit is a little overblown in my opinion. I still think this will be a quality business. The UK has a chronic undersupply of housing, and companies like this will be necessary, and I really like Redrow's management and its product offering. Even with the chronic undersupply of housing, because of the interest rate rise that the Bank of England are doing and are likely to continue doing, right now interest rates are around 4% and inflation is around 10%. That cannot be allowed to go on. Interest rates will likely continue to rise. Annual house price growth turned negative in February for the first time in almost 3 years, falling to its lowest level since November 2012. I can see house prices continuing to fall in the short term, and this is reflected in the performance of FTSE 100 and FTSE 250 house builders. This is not including Redrow, which is down around 20%, but you can see its peers, so the first three, Persimmon, Barratt Development and Taylor Wimpey, are all on the FTSE 100. These have been hit massively. Persimmon down 47% in the last year, Bellway 29%. This is because their earnings are going to be dramatically hit. In the previous higher interest rate cycle, the Help to Buy came in, the government introduced the Help to Buy scheme. That doesn't look like it's going to be happening anytime soon, and despite a chronic undersupply of housing, it looks like the house builders are going to be kind of left out to dry. However, I do think these market reactions are a little overblown in the medium term, so in the next 3 to 5 years, I still think these will be great investments. Just in the next 1 to 2 years, they're going to take a significant hit to their earnings. However, I think that is more than priced in for some of them, particularly for Persimmon, down 47%. I think that's a bit of an overreaction. Next is TESCO at 10.9% of the portfolio. Obviously, the UK's largest grocery store, around 30% market share of UK groceries. That's more than double its next competitor. Business as usual for this company. Steady results. Low single-digit revenue increase, low single-digit earning increase, dividend increase, now a dividend yield of 4.27%. Really nice. Great returns so far this year, primarily due to just the inherent safety of groceries. I had a little bit more in October and I've been handsomely rewarded for that. You can see the stock was around 210 in October and it's now in the 250 range. It's a great company. It doesn't really shock. It's not going to announce earnings of plus 20% in a year, but it's just going to steadily tick along, and it's trading for a reasonable price to earnings ratio given its strong track record at just 11 with 4% dividend yield, and maybe adding some more to this in the future. But position sizing wise, I don't really want to see this go above 12% or so. I'm quite happy with where it is right now, so maybe I'll have to see some changes in the rest of the portfolio to add to this. The next position and 9.4% of the portfolio is actually a new position which I started in February and have been continually adding to. That is TRITAX Big Box REIT. This is not a well-known name, certainly not on the scale of TESCO and DIAGEO. It's a real estate investment trust. It's not dissimilar from Realty Income in the sort of properties that it holds. I'm not going to talk about it too much because I've done a separate video on this which you're free to look at. I'll put the link down below in the description. A couple of points on it. A nearly 5.2% dividend yield, which is absolutely excellent. Significant discount versus net asset value, which is really important when you're looking at REITs in my opinion. A 28% discount versus net asset value is absolutely huge. And just a really secure portfolio of clients that made me have a lot of faith in this company. And it was trading for really decent prices in my opinion. £2.25 less than a year ago, and now it's down to 130, 140. Just a gross overreaction in my opinion. I think this is an excellent company. I'm probably going to add a little bit more, but this is pretty much a fully sized position at this point, unless a big opportunity like it dropping close to a pound. Unless a big opportunity like that comes around, I don't think I'll be buying any more. Next is pharmaceuticals giant GSK, GlaxoSmithKline, 8.45% of the portfolio. Out of all the earnings report that I read for the company in my portfolio, this is by far the one I was most excited about. Since it spun off Haleon, it really became a much more focused business, focusing away from its consumer goods arm, spinning that off because of its very low growth, while consistent low growth, focusing on vaccines and medicines, and boy has it paid off. 19% revenue growth for the full year, 18% earnings per share growth. I'm very optimistic about this business. It's currently trading at 17 times free cash flow, or trailing 12 months free cash flow, with a 4.45% dividend yield. 69 pipeline vaccines and medicines. The largest business segment, which was specialty medicines, was up 29%. This is a really impressive business that is really starting to turn the wheels when it was stagnating for a long time, primarily due to the consumer goods arm, in my opinion, dragging this business down slightly. Nevertheless, still an excellent business, and it is growing like a wildfire at the minute. Next is Boohoo Group at 7.3%. Again, may raise some eyebrows. It doesn't actually pay a dividend. However, I just wanted some exposure to a speculative business. This overall is designed to be an income portfolio eventually, but I think eventually Boohoo will pay a dividend, and I wanted some exposure to growth. It wasn't a brilliant investment at first. I invested in around August last year, so the stock price dipped initially. I'm slightly above even right now with all the ads I've done. It's up 42% year to date. Not really much has happened in my opinion. New share incentive scheme for management highly incentivises them to get back to its 2021 levels of around £3. But overall with the business, pretty much nothing has happened, and it's gained nearly 50% year to date, which obviously I'm happy with, but strange nevertheless. PE ratio on a trailing basis now just shy of 12. If this business can get back to growing how it was in 2021, that'll be a perfectly good price to be paying, and may even look cheap in the near future. Next is Unilever at just 2.7% of the portfolio. Nothing really happened with this business, as per usual. Classic blue chip company, really steady results, flat volume but had some increase in pricing, which gave it decent mid-single digit revenue growth. I'm looking for some more opportunities to add to this below £40. It's essentially the closest thing to a dividend aristocrat you could have in the UK. Fantastic business, one of the best consumer goods businesses in the world. 3.64% dividend yield. 5-year return basically flat, obviously not including dividends, but I think it can get back close to £50 in the near future. P ratio is currently 18. That's a little rich in my opinion. I don't really want to be adding to this business above £40. If it gets back to around 3,500 pence, now we're talking. That's when I'll be adding significantly to this business. But when businesses are mostly flat over 5 years and they have steady Eddie results, I think price is very important, and I want to be looking at adding this in the £35 range rather than overpaying slightly, in my opinion. The only real underperformer in this portfolio so far this year is Admiral, which dropped significantly. It's dropped around 11% year to date. Poor US results hurt the business profits. Overall revenue is up mid to single digits. It's an insurance business. Occasionally, really bad weather, natural disasters, etc. can cause businesses like this to have lumpy earnings. I'm completely fine with that. That's kind of what you get involved with when you invest in a business like this. It's only around 2% of the portfolio, so it's not the end of the world. Trail earnings are around 15. If it gets back to normal profitability, so ignoring the natural disasters, then it's going to be close to around 8 or 9, which is a very reasonable price for this business. Currently a 4% dividend yield, which is extremely likely to maintain, if not grow, and just a $6 billion market cap, or £6 billion market cap, sorry, I can see this growing significantly in the future once it gets away from those lumpy earnings. I think there's a lot of room to run for this stock and get back to the £28, £29 mark that it was not so long ago. A couple of the other smaller positions, Haleon has dropped significantly in this portfolio because I haven't been adding to it. I'm weighing up whether I want to sell this position or not. It's basically, it's like 1.8, 1.9% of the portfolio, so it doesn't really have an effect on the large business, so I'm happy to keep it for now. And it has been a decent performer, it's up 15%. I'm just not totally enamoured with the business. I think I've got enough consumer goods exposure with Unilever, which I am looking to add to at the right price. I think Haleon's price is maybe a bit rich right now. National Grid as well. I basically don't add to this if it's above £9. If it's below £9, I would think about adding to it. Given the current energy crisis, it's not likely to be below £9 in the near future, so I'm quite happy to let this sit. And the other two are Vodafone, which I'm looking to sell, I just haven't got round to it, which is a very small position that I did a long time ago, started building out a position, so bad news came out and I didn't add to it. And Warehouse REIT, which I've kind of started filling that exposure with TRITAX Big Box now, exposure to REIT, so I may sell Warehouse REIT, but who knows, I might keep it for the time being because I don't often sell. With that being said, that's the end. You let me know what you think in the comments down below. Let me know about your portfolio. Let me know if you think any of these businesses are interesting, or some businesses that you may think I might find interesting. I'm looking at Ashtead at the minute very closely because of the problems going on with the US economy. That stock price came down significantly recently. Looking at a couple of other businesses, but you let me know. Of course, none of this is financial advice, just my dividend portfolio for you to look at, you to comment on. You should do your own research and due diligence, not just buy things because I own them. Like, subscribe, and enjoy the video. I'll see you again next time.